So if you want to know if like a software company is healthy, you usually just look at their recurring subscription.
Yeah, that's pretty much the standard playbook.
Right. You check the churn rate, you look at, customer acquisition costs, and you basically call it a day.
It's all digital.
Exactly. But if you want to know if a modern biotech company is healthy, well, apparently you have to figure out if they're secretly hoarding memory chips.
Yeah, which is crazy to think about.
Right. And you have to see if they're navigating global geopolitical entity lists and successfully mapping the actual fundamental source code of human life.
All in a day's work.
Right. All while maintaining profit margins that would honestly make a Silicon Valley sauce CEO incredibly jealous. So welcome to the deep dive.
Thanks for having me back.
Today we are looking at Illumina. Ticker symbol ILMN. And this is a special Talk Tickers deep dive.
It is, because Illumina, it is a completely different animal than your standard tech play.
Oh, totally.
You're moving from a world of purely digital bits and bytes into a world of physical atoms, right? Biology, and just incredibly complex hardware.
And that's exactly why we're dedicating this entire conversation to unpacking their Q2 2026 earnings call.
Yeah, there's a lot to dig into there.
There really is. We've got the transcript, we've got the commentary from CEO Jacob Thaysen and CFO Ankur Dhingra, and we have a very specific mission today for you listeners.
Which is much needed, honestly.
Yeah, we're going to strip away the impenetrable Wall Street and biotech jargon. We want to understand the actual underlying mechanics of this business.
Right, because you need to decide if this is a holding that actually belongs in your retail portfolio.
Exactly, because Illumina isn't just a participant in the healthcare sector. They are the bedrock.
They really are the infrastructure. If you're investing in next generation healthcare or, targeted oncology or personalized medicine, you are implicitly investing in the tools that enable those fields.
Right, you can't have one without the other.
Exactly. And right now, no one provides more of those tools than Illumina.
But having a great technology and having a great investable business, well, those are two very different things, right?
Oh, absolutely. 100%.
So to figure out if Illumina is the latter, we really have to look closely at both the macroeconomic environment they're in right now and the micro-level execution of their strategy.
Right. The day-to-day operations.
Yeah. So let's start with the absolute foundation, which is the headline numbers.
The fun stuff.
Right. Because before we talk about mapping the human genome, we have to talk about mapping their income statement.
Very true. You got the numbers handy.
I do. So total revenue for Q2 came in at $1.16 billion, which is a 9.5% increase year over year.
Not bad at all.
No, not bad. But the number that really jumps off the page in the transcript is their rest of world organic revenue.
Yeah. That's the crucial metric right now.
It is. So this figure excludes China, and it increased 8.1% year over year, which absolutely crushed management's previous guidance.
Blew it out of the water.
But what exactly is going on with that specific geographic exclusion? Why carve China out of the organic growth story entirely?
Yeah, it's a really vital distinction if you want to understand their true operational momentum.
Okay, lay it on me.
So Illumina explicitly excludes Greater China from this organic growth calculation because, well, they were recently placed on China's unreliable entity list.
Oh, wow. Okay. So that's a pretty big deal.
It is. Now, from a purely analytical standpoint, stripping away any geopolitical commentary, this just creates a massive headwind for a global company.
Right, because suddenly this massive market is just restricted.
Exactly. So what management is trying to show investors by breaking out that rest of world metric is how the core business is performing in markets where they can freely operate.
I see. North America, Europe, Latin America, Japan.
Yeah, exactly.
They're essentially saying, hey, look at how our sales force performs when both hands aren't tied behind their backs.
That is exactly what they're saying. And an 8.1% organic growth rate in those unrestricted markets, that suggests their global demand is actually incredibly resilient.
Okay, that makes sense. It proves the core product is still, highly desired globally.
Precisely. But, the top line is only half the story.
Always. We have to look at what they're actually keeping.
Right. So let's talk about earnings per share. EPS came in at $1.31 on a non-GAAP basis.
Okay.
That is a solid 10% year-over-year growth. And actually, if you adjust for the dilutive impact of some of their recent acquisitions, that underlying growth is closer to 13%.
Okay, I want to hover right there for a second because I want to challenge this a little bit.
Go for it.
A 10% or even 13% EPS bump is nice, right? Nobody's going to complain about double-digit earnings growth.
Sure.
But we are talking about the bleeding edge of biotechnology here. We're talking about the company that literally sequences DNA.
Right.
So in the high-flying tech and biotech sectors where investors are routinely hunting for like 40% or 50% growth, is a 10% EPS bump actually a home run? Or is that just a respectable base hit?
Well, it depends on your perspective.
Like, are they underperforming the hype of their own industry?
So if you're evaluating Illumina through the lens of a pure software startup, yeah, you might walk away unimpressed by 10%.
Right.
But that is a fundamental misunderstanding of what Illumina actually is as a business.
Okay. Educate me. What are they?
They are a heavy manufacturing company.
Oh, interesting.
Yeah, I mean, they build incredibly complex, highly sensitive physical machines. These things contain precision optics, lasers, microfluidics, advanced robotics.
Wow, okay. That is definitely not sus.
Not at all. They have to deal with physical raw materials, global shipping logistics, warehousing, complex assembly lines.
The overhead is just massive.
Exactly. So achieving a 10% to 13% bottom line growth while navigating the physical realities of manufacturing in the current global supply chain environment, that is exceptionally difficult.
So you're saying we really need to grade them on a hardware curve, not a software curve.
Exactly. And this becomes glaringly obvious when you look at their margins.
I was looking at those.
Their non-GAAP gross margin hit 68.2% this quarter.
Which is wild.
And their operating margin reached 22.5%. I really want to emphasize how rare a 68% gross margin is for a company selling physical hardware.
Yeah, that feels almost illegal for hardware.
Right. If you're building a physical machine with lasers and pumps, and you're keeping 68 cents on every dollar of revenue after the cost of goods sold, you've achieved a level of manufacturing scale and pricing power that is almost unheard of.
Outside of, like, maybe Apple?
Yeah, pretty much just Apple.
Okay, let me make sure I'm mapping this correctly, because a massive part of that margin profile has to come from the business model itself, right?
Absolutely.
Because they aren't just selling $1 million box and walking away. When I read through this transcript, it struck me that their entire financial engine operates almost exactly like a video game console ecosystem.
Oh, that is a much more accurate framework than the traditional analogies people use. I like that.
Right.
Walk me through how you see it.
Okay, so think about Sony and the PlayStation.
Okay.
When Sony sells you a PlayStation 5, the physical console is incredibly expensive to research, develop, and manufacture.
Very expensive.
They might even sell the console itself at a very low margin, or, sometimes even at a loss. But they don't care.
Because they've got you.
Exactly. Because once that box is sitting in your living room, you're locked into their ecosystem. You're buying the monthly PlayStation Network subscription, you're downloading digital games, you're buying microtransactions.
Right.
So the console is really just the Trojan horse to get you to buy the high margin, recurring software and services. And it seems like Illumina is running this exact same playbook, just scaled up for multi-million-dollar scientific laboratories.
It is the exact same underlying architecture. You nailed it.
Okay, cool.
Illumina sells the sequencer.
Right.
That's the biological console. And right now, their flagship console is the NovaSeq X.
The NovaSeq X.
Got it. Yeah, it's this massive, incredibly powerful machine designed for high throughput, production-level genomic sequencing. That's your capital expenditure.
Okay.
But the machine is utterly useless without the specific chemical consumables, the reagents, the flow cells required to actually run the genetic samples.
And those consumables are the video games and the monthly subscriptions.
Exactly. And they are highly proprietary. You cannot run an Illumina sequencer using generic third-party chemicals.
You have to buy from Illumina.
Every single time.
And that is where those massive 68% gross margins come from, selling specialized chemicals over and over again to a totally captive audience.
You got it.
So let's look at the adoption rate of their new console. In Q2, the transcript notes they placed over 95 NovaSeq X instruments.
Which is a solid number.
Right, because 95 units of anything doesn't sound like a lot until you realize these machines cost roughly $1 million a piece.
Yeah, that changes the math a bit. And placing 95 of them in a single quarter is a massive indicator of market confidence. Well, when a hospital system or a major research university signs a purchase order for $1 million piece of capital equipment, that is not a casual decision.
Right, nobody's impulse buying a NovaSeq X.
Exactly. That requires board approval, budget reallocation, and a long-term strategic commitment to the Illumina ecosystem.
But the placement number, while impressive, isn't the most important metric, is it?
No, it's not. The most critical data point from this call is that 83% of total sequencing volumes and 59% of revenue have now transitioned onto this new NovaSeq X platform.
Wait, 83% of the volume is already on the new machine?
Yep.
That seems incredibly fast for an industry that moves as methodically as healthcare. I mean, why are labs rushing to transition so quickly?
It's all about unit economics.
What makes the NovaSeq X so much better than the previous generation that it literally forces a lab to spend $1 million to upgrade?
It comes down to raw throughput and the cost per genome.
Okay.
The NovaSeq X can sequence vastly more human genomes in a single run than previous iterations, and it does so at a significantly lower cost per sample.
Oh, I see.
And in the world of genomics, driving down the cost of reading DNA is the holy grail.
So if a lab is using older technology, their cost per test is naturally higher.
Right. And if their competitor across the street buys a NovaSeq X, that competitor can offer the exact same genetic test for less money. Or they can sequence twice as many patients in the same amount of time.
So it's literally an arms race.
Total arms race.
If you're a high-volume lab, you literally cannot afford to stick with the old console because your unit economics will be destroyed by anyone using the NovaSeq X.
Exactly. It forces adoption. And once they adopt, the recurring revenue engine kicks in.
The video game sales.
Right. Management highlighted that sequencing consumables revenue hit $775 million this quarter, which is up 5% year over year.
Okay, but this brings us to a really fascinating divide in the transcript. Because when you dig into who is actually buying these machines and these consumables, the customer base is splitting in two entirely different directions.
It's a tale of two sectors right now.
It really is. You have a massive boom in the clinical space, and then serious gloom in the academic research space.
The divergence is stark. And it tells us a lot about the maturation of genomic technology.
Let's tackle the clinical side first, because this seems to be the primary engine driving the company forward right now.
It absolutely is. So clinical consumables revenue grew 15% year over year, excluding China.
Wow.
And if you look specifically at the U.S. and Canada, they were absolute powerhouses. They grew at over 20%.
Okay, just to be incredibly precise here for the listener, when Illumina says clinical, what exactly are we talking about?
Good question.
Because we aren't talking about scientists in white coats pipetting things to discover a new species of frog, right? We're talking about human hospitals.
Yes.
Yeah.
We're talking about direct patient care, diagnostics that inform an actual medical decision.
Okay, got it.
And the most prominent examples driving this 20% growth are oncology. So specifically cancer testing and NIPT, which stands for non-invasive prenatal testing.
Okay, let's pause on NIPT for a second, because I think a lot of people don't realize how revolutionary this is or how much volume it drives for a company like Illumina.
It's massive.
How does that actually work mechanically?
It is a brilliant application of the technology. So historically, if a doctor wanted to check a fetus for genetic abnormalities like Down syndrome, they had to perform an amniocentesis.
Right. Which is pretty intense.
Very intense. It involved inserting a long needle into the mother's abdomen to extract amniotic fluid. It's invasive, it's incredibly stressful, and it carries a small but real risk of miscarriage.
Yeah, that's a high-stakes test.
But then, biologists discovered something incredible. As a fetus grows, tiny fragments of its DNA actually cross the placenta and float freely in the mother's bloodstream.
Oh, wow. Cell-free fetal DNA.
Yes, exactly. So with NIPT, a doctor simply draws a normal vial of blood from the mother's arm. That's it. They send that blood to a lab equipped with an Illumina sequencer. The machine sequences the millions of DNA fragments in the blood, uses advanced algorithms to isolate the fetal DNA from the maternal DNA, and screens it for chromosomal abnormalities.
That is wild.
It's entirely non-invasive, incredibly accurate, and can be done much earlier in the pregnancy.
And because it's just a simple blood draw, it goes from being this specialized, high-risk procedure to something that can be offered as a standard of care to millions of pregnant women every single year.
Exactly.
That is a staggering amount of recurring volume for Illumina's machines.
It's a huge baseload of volume.
But NIPT has been around for a little while now. The transcript seemed incredibly focused on another clinical application, MRD.
Yes, minimal residual disease testing.
Okay, what is that?
Well, if NIPT was the first massive clinical wave for sequencing, MRD is the tsunami that is currently building.
The tsunami. I like that.
It applies the exact same logic looking for fragments of DNA in the blood, but it applies it to cancer.
Okay, break this down for me. If a patient is undergoing treatment for cancer, how does sequencing their blood tell a doctor if the treatment is working?
So let's look at how we traditionally monitor cancer. Let's say a patient has a tumor removed and they go through chemotherapy.
Okay.
The oncologist needs to know, did we get all of it? Is there any microscopic cancer left anywhere in the body?
Right.
Historically, the only way to check was to wait months and do a PET scan or an MRI. And you basically just hope that if the cancer came back, you caught the tumor when it was still small.
Or you do those highly invasive, painful surgical biopsies.
Exactly.
Which means you are always playing defense. Like you're waiting for the enemy to gather enough troops to show up on satellite imagery rather than catching the scouts.
Oh, that is a perfect analogy. MRD flips that script entirely.
How so?
Just like a fetus sheds DNA into the mother's blood, tumors actually shed microscopic fragments of mutated DNA into the patient's bloodstream.
Okay.
This is called circulating tumor DNA, or ctDNA. So MRD tests take a simple blood draw from the cancer patient and sequence it at an incredibly deep level to look for these specific mutated tumor fragments.
So it's literally looking for a microscopic needle in a haystack of healthy blood cells.
Yes. And doing that requires immense sequencing power.
Because there's so much noise.
Exactly. It requires a machine that can read millions of fragments flawlessly because you are looking for a signal that might only be a fraction of a percent of the total DNA in the sample. This is why the NovaSeq X is so critical. Its massive throughput and lower cost per genome allow labs to run these incredibly deep, computationally heavy MRD tests at a price point that actually makes sense.
And think about the financial mechanics of this for Illumina.
It's beautiful for them.
If you're a cancer patient in remission, you don't just get an MRD test once.
No, not at all.
Your oncologist might order a blood draw every month or every quarter for years just to monitor for recurrence.
Yes.
That transforms a single patient from a one-time sequencing event into a multi-year recurring revenue stream. No wonder the clinical side in the U.S. is growing at 20%. The technology is literally becoming the standard of care for oncology.
It is entirely shifting genomics from a tool of discovery into a tool of daily medical management.
Right. But as you noted earlier, that explosive clinical growth is kind of masking a significant problem on the other side of the house.
Right, the research gloom.
Yeah. According to the transcript, research and applied consumables dropped 7% year over year.
Which is tough to see.
What is happening here? I mean, if the machines are so powerful and the cost per genome is dropping, why are the academic researchers pulling back? Is the science slowing down?
The science definitely isn't slowing down, but the funding mechanisms that support the science have hit a massive macroeconomic wall.
Okay.
You have to look at the business models of the two distinct customer bases. Clinical labs generate revenue by performing a test and billing an insurance company or a healthcare system, right?
Right. They have a direct recurring revenue stream.
Exactly. Research labs, which are primarily housed within universities and academic institutions, they do not bill insurance. They rely almost entirely on grants.
Mostly government grants, right? Like from the National Institutes of Health in the U.S. or equivalent bodies in Europe.
Exactly. And the grant cycle is highly sensitive to macroeconomic conditions.
Makes sense.
Right now, academic institutions are facing immense uncertainty. High interest rates are impacting university endowments. Government budgets are constrained.
So it's tight everywhere.
A researcher running a lab right now might have funding for this quarter, but they literally do not know if their grant will be renewed for the next fiscal year.
So it's not that they don't want to buy the reagents to run their experiments.
No, they want to.
It's that they are hoarding their cash because they are terrified their funding is going to evaporate. It's basically a capital preservation strategy.
That is exactly what CEO Jacob Thaysen conveyed on the call. He stated that academic customers remain highly cautious.
Did they see any light at the end of the tunnel?
Well, while management saw some faint signs of improvement late in the quarter, Thaysen was very disciplined in setting expectations. He made it explicitly clear that it is too early to call a true recovery in the academic space.
This is such a vital dynamic for retail investors to grasp because the core engine of Illumina has fundamentally shifted.
It really has.
For the first decade of this company's life, they were essentially a research tools company.
That was their bread and butter.
But now, clinical applications represent roughly 65% of their sequencing consumables revenue.
Which is a huge flip.
Yeah. The clinical side is growing so fast and is now so massively large that it is easily absorbing and overpowering a 7% contraction in the academic market.
It just proves that the business model is successfully transitioning. They're moving away from a reliance on fragile research grants to the much more durable, deeply pocketed world of healthcare spending.
That's a great place to be. Okay, let's pivot to the operational mechanics, because there was a detail in the Q&A portion of the earnings call that I found fascinating.
Oh, I think I know what you're going to bring up.
We touched on their 68% gross margins earlier, but during the quarter, CFO Ankur Dhingra explicitly mentioned that they had to absorb higher freight costs and higher memory chip costs.
Yeah, that was a key moment in the call.
Because anyone who follows the tech sector knows that memory chips have been incredibly volatile and expensive lately, primarily because the massive artificial intelligence boom is sucking up all available silicon.
Right.
So how did a hardware company like Illumina absorb rising semiconductor costs and still beat their margin expectations?
This is where we see the difference between a reactive management team and a proactive, highly disciplined one.
Okay, what did they do?
When the analyst pushed Dhingra on the memory cost issue, he revealed a crucial, actionable detail about their supply chain strategy.
Which was?
He explained that Illumina actively secured additional inventory and pre-bought the supply for critical components for the next several quarters.
Wait, they essentially looked at the inflation in the semiconductor market and decided to aggressively hedge their bets, like they bought the dip on their own supply chain.
Yes, exactly. They utilized their extremely strong balance sheet. They ended the quarter with $1.17 billion in cash and short-term investments, by the way.
Wow.
And they use that to completely de-risk their near-term exposure to memory price fluctuations.
That is smart.
By locking in their costs up front, they ensured that their margins won't get suddenly compressed in Q3 or Q4 if chip prices spike again. It's a textbook example of using cash as a defensive mode.
But wait, I have to ask about the elephant in the room regarding silicon.
The GPUs.
Yes. The entire AI revolution is built on GPUs. Graphics processing units, specifically the ones made by NVIDIA.
Right.
They are notoriously expensive, incredibly power-hungry, and currently facing a massive global shortage. So if Illumina's machines are processing literal terabytes of genomic data, how are they not getting absolutely crushed by the GPU shortage? Are they just waiting in line behind Microsoft and Meta to get chips for their sequencers?
This is a brilliant architectural advantage that Dhingra specifically highlighted on the call. Illumina does not use GPU architecture for the primary data processing on their sequencers.
Wait, really? How do they process that much data without a GPU?
They utilize a different, highly specialized computing architecture.
Okay.
While he didn't dive into the deepest engineering weeds on the call, companies like Illumina typically rely on things like FPGAs.
Field programmable gate arrays.
Yes.
Yeah.
Or custom ASICs.
Got it.
These are chips that are hardwired to do one specific mathematical task incredibly well, rather than being a general-purpose processor like a GPU.
Oh, that's clever.
Because they designed their own computing architecture, tailored specifically for genomic data, they completely sidestepped the AI hardware traffic jam.
Wow.
They aren't competing with OpenAI for silicon. They have a secure, custom, and vastly more cost-efficient computing pipeline.
That is such a critical piece of the puzzle. They are totally insulated from the biggest supply chain bottleneck in the modern tech economy.
It's a huge advantage.
Okay, so they crushed Q2, they managed their supply chain like seasoned veterans, and they proved their clinical business is a juggernaut. But as we know, the stock market does not care what you did yesterday. It only cares what you are going to do tomorrow.
So true.
Let's talk about management's guidance for the rest of 2026. What exactly did they promise?
Well, they delivered a highly confident, upgraded outlook.
Which is what you want to see.
Based on the strength of Q2, they raised their full year 2026 revenue guidance by $50 million at the midpoint.
Okay, so establishing a new expected range of what?
Of $4.60 billion to $4.64 billion.
Nice.
They also bumped up their full year EPS guidance to a range of $5.30 to $5.40.
That is exactly the combination you want to hear if you're holding a stock through earnings. A solid beat on the current quarter, accompanied by a tangible raise on the full year.
Yeah, but shows management isn't just getting lucky. They have real visibility into their future sales pipeline.
However, when I was digging into the quarter-by-quarter breakdown they provided, I noticed a very strange quirk.
Let me guess. Q3.
Yes. Their Q3 revenue guidance actually looks a bit softer. They guided for $1.14 billion to $1.16 billion for Q3, which is technically a slight step down from the $1.16 billion they just printed in Q2.
Right.
If the business is booming, why this sequential dip?
Well, you aren't the only one who noticed that. An analyst jumped on that exact discrepancy during the Q&A.
Good for them.
The CFO, Ankur Dhingra, clarified that this is simply the normal seasonality of their business model.
Oh, seasonality. Okay.
Q3 is historically a slightly softer quarter due to summer dynamics in academic and clinical purchasing. But things ramp back up significantly in Q4, which is traditionally their massive budget-clearing quarter.
That makes sense.
But there is a much more important accounting nuance that Dhingra pointed out, one that retail investors absolutely must build into their models if they're projecting out to the end of the year.
Yes. The dreaded 53rd week.
Exactly. The 53rd week. This is one of those corporate accounting quirks that trips up retail investors every single time.
Walk us through how this actually works. Like, how does a year suddenly just have an extra week?
It comes down to how companies structure their financial calendars.
Okay.
Most companies don't use strict calendar months because months have different numbers of days, right? Which makes year-over-year comparisons pretty messy.
True.
Instead, they use something like a 4-4-5 calendar format. 4 weeks, 5 weeks per quarter.
Right.
But a standard 52-week year is only 364 days. That missing day or 2 days in a leap year slowly accumulates over time.
Oh, I see.
So eventually, to realign the financial calendar with the actual solar calendar, a company has to insert a 53rd week into their fiscal year.
That's so weird.
For Illumina, that realignment happens in fiscal year 2026, and that extra week falls squarely in the fourth quarter.
So mechanically, what does that actually mean for their financials?
It means that in Q4 of 2026, Illumina has an extra 7 days to sell machines, ship consumables, and recognize revenue compared to Q4 of the previous year. Management explicitly stated that they expect this extra week of operations to add a 0.5% phantom bump to their total Q4 revenue.
That is a brilliant detail to catch.
Yeah, you have to be careful.
Because if you're an investor looking at Q4 results next year and you see this sudden spike in revenue, you might mistakenly assume demand is just accelerating wildly.
Exactly. But in reality, 0.5% of that growth is just the calendar playing tricks on you.
Right. It's a one-time accounting artifact, not a fundamental shift in demand.
Precisely. You have to normalize the data by stripping out that 53rd week to see the true underlying growth rate.
Okay, so the core legacy business is chugging along nicely, the clinical transition is working, and the supply chain is secure.
Yes.
But let's look beyond the current fiscal year. Let's talk about the moat, the technologies that will protect Illumina from competitors 5 or 10 years down the line.
The future stuff.
Right. Because the transcript spends a significant amount of time discussing new initiatives that honestly sound more like science fiction than earnings drivers.
They do sound pretty wild.
Like the billion-cell atlas, multi-omics, spatial biology. Let's translate this pipeline. What is the billion-cell atlas?
The billion-cell atlas is arguably one of the most important forward-looking projects in their portfolio right now. It falls under their BioInsight initiative.
Okay.
Essentially, Illumina is moving beyond just building the tools to read DNA, and they are actively creating a massive proprietary genome-wide data set.
A data set.
Yeah. They announced on this call that they have already sequenced and delivered 300 million cells for this project, and they just signed 3 new major biopharma partners.
Bringing the total number of partners to 6.
Exactly. 6 major partners.
Okay, let's be real for a second, though. What are 6 pharmaceutical companies going to do with a database of 300 million sequenced cells? Like, is this just a shiny science fair project that researchers love to talk about at conferences, or is there an actual commercial use case here?
It is entirely commercial, and it sits right at the intersection of biology and artificial intelligence.
Oh, AI, of course.
These biopharma companies are using this massive, incredibly uniform data set to train their proprietary AI models for drug discovery.
Oh, wow.
If you want to use AI to figure out how a specific genetic mutation causes a disease or how a new chemical compound might fix it, you cannot train that AI on messy, fragmented data from a dozen different sources.
Right. Garbage in, garbage out.
Exactly. You need a massive, standardized, perfectly sequenced foundational data set.
It's the biological equivalent of training a large language model. Like, OpenAI needed the entire internet to train ChatGPT to speak English. These pharma companies need the billion-cell atlas to train their AI to speak human biology.
That is exactly right. The data must possess the specific quality and consistency needed to support true biological discovery.
And the most compelling part for investors is that this isn't some speculative future project.
No, not at all.
It's generating data revenue for Illumina today. 6 major pharmaceutical companies are actively paying them right now for access to this data layer.
It's a massive paradigm shift.
But it isn't the only one they discussed. The transcript heavily features another major buzzword, multi-omics.
Yes.
They highlighted the launch of a new product called StrataMap Spatial, and they talked at length about the integration of a company they recently acquired called SomaLogic.
Right. Huge acquisition.
I have to play the skeptic again. Does a retail investor actually need to care about multi-omics? Or is this just another way to sell slightly different chemicals to the same academic labs?
To understand why it matters to the bottom line, you have to understand the fundamental limitation of just reading DNA. And this is where SomaLogic and proteomics come in.
Okay, explain proteomics.
Let's use an analogy. DNA is essentially the architectural blueprint of a house.
Okay.
It tells you what the house is supposed to look like. But looking at the blueprint doesn't tell you if the house was actually built correctly, if the plumbing is leaking, or if the roof is caving in.
Right. Having the gene for a disease doesn't necessarily mean you actively have the disease. It just means you have the blueprint for it.
Precisely. The actual physical structures in your body that do the work. The bricks, the mortar, the plumbers, and the electricians are proteins.
Oh, okay.
Proteomics is the study of those proteins. SomaLogic is a company Illumina acquired that specializes in reading proteins at a massive scale.
Oh, I see how they fit together now.
By combining genomic data, the blueprint, with proteomic data, the actual workers, a researcher gets a vastly more complete picture of what is actually happening in a patient's body.
And that is the essence of multi-omics, multiple omics together.
Exactly.
Okay, that makes total sense. But what about StrataMap and this concept of spatial biology?
Spatial biology adds the final layer of context. Think about traditional sequencing, like making a smoothie.
Like a smoothie.
Yeah, you take a piece of tumor tissue, you grind it all up in a blender, you sequence it. You get a highly accurate list of all the ingredients in the smoothie.
Okay.
You know exactly what mutated DNA and what proteins are present.
But you have completely destroyed the physical structure of the tissue.
Exactly. You don't know how those ingredients were arranged before you blended them.
And in diseases like cancer, the arrangement is everything, right?
It is everything. You need to know.
Yeah.
Are the patient's immune cells successfully infiltrating the center of the tumor to fight it? Or are they just sitting uselessly on the outside edge?
Oh, wow.
Spatial biology, which is what the StrataMap product enables, allows researchers to sequence the tissue while leaving it physically intact.
So it doesn't give you a smoothie?
No. It gives you a high-resolution map. You can literally see exactly where the mutated genes and proteins are located physically within the tissue sample.
The map versus the smoothie. I love that analogy.
It really paints the picture.
It instantly clarifies why a researcher would demand this capability. But let's bring this back to the investor perspective. How does selling the map and the smoothie actually drive revenue for Illumina?
It is all about creating the ultimate ecosystem lock-in.
Okay.
Illumina's goal is to provide the complete end-to-end biological workflow.
Right.
If a researcher can get their foundational DNA data from the NovaSeq X, their protein data through the SomaLogic integration, and their spatial map through the StrataMap workflow, all seamlessly integrated into one software environment, they are never going to leave that ecosystem.
It's the Apple playbook applied to molecular biology.
Exactly.
Once you buy the iPhone, you buy the Mac because it seamlessly syncs. Then you buy the Apple Watch because it integrates perfectly. The switching costs become astronomically high.
You're trapped, but in a good way.
Right. If a major hospital standardizes its oncology department on the NovaSeq X, the StrataMap spatial workflows, and the SomaLogic proteomics tools, they are an Illumina customer for life. It is just too painful and expensive to switch to a competitor's fragmented system.
Precisely. And management confidently stated on the call that these new multi-omics products are expected to add 1% to 2% to their total top-line growth next year.
Wow.
These are not just shiny academic toys. They're highly profitable, specialized tools that lock customers deeper into the platform and generate entirely new streams of consumable revenue.
All right, so we've dissected the headline numbers. We've broken down the structural transition from research to clinical. We've analyzed their masterful navigation of the supply chain, and we've mapped out the future multi-omics moat.
We've covered a lot of ground.
We have. Now, let's synthesize all of this data into a concrete, actionable thesis for the retail investor listening right now.
Okay, let's do it.
When you look at the totality of this Q2 earnings transcript, what is your ultimate conclusion?
Based on the raw data and the strategic commentary provided in this transcript, I take a decidedly bullish stance on Illumina's operational trajectory.
A bullish stance.
Definitely. And that conviction is primarily rooted in the definitive debunking of the clinical cliff.
Yes, let's unpack the clinical cliff because this has been the dominant bear narrative surrounding Illumina's stock for the past 12 months.
It's all anyone could talk about.
The fear on Wall Street was essentially a transition gap, right? The theory was that as massive clinical labs decided to upgrade to the new NovaSeq X, they would have to pause their operations. They would stop buying the highly profitable chemical consumables for their old machines while they spent months setting up the new machines. Therefore, Illumina's recurring revenue would just temporarily fall off a cliff.
That was the prevailing fear, yes. But CEO Jacob Thaysen used this earnings call to definitively kill that narrative.
How so?
He explicitly told analysts that they are not seeing a cliff. They are experiencing a wave. And the Q2 data absolutely backs him up.
Because they just grew clinical consumables by 15% year over year, right in the middle of their largest hardware transition in a decade.
Exactly. They didn't fall into the gap. They bridged it entirely.
The clinical demand for NIPT and MRD testing is so overwhelming that labs literally can't afford to pause. They are running the old machines at full capacity while simultaneously spinning up the new ones.
Exactly. So what does this mean for an investor? If you hold or are considering opening a position in ILMN, you should view it as a highly defensive growth play within the broader healthcare sector.
Ooh.
And the most important leading indicator you need to focus on from this call is not the current quarter's revenue, but those 95 plus NovaSeq X placements.
Connect the mathematical dots for us. Why do those 95 placements dictate the future?
Because of the regulatory and scientific reality of clinical validation.
Okay, what does that mean?
When a hospital installs $1 million NovaSeq X to run cancer diagnostics, they cannot just plug it in and start testing patients the next day.
Oh, of course not.
They are subject to intense regulatory oversight, things like CLIA certification and CAP accreditation.
So they have to test the machine first.
Extensively. They have to spend 6 to 9 months running parallel samples, testing the new machine against the old machine, calibrating the lasers, and proving to regulators that the new setup is flawless.
So during that 6 to 9 month validation window, the machine is basically just idling in the garage. Like it isn't consuming massive amounts of the high margin chemicals yet.
Exactly. A clinical customer takes 6 to 9 months to reach their normalized consumable pull-through rate.
Wait, I see where this is going. If they place 95 machines in Q2 of 2026, and those machines require a 6 to 9 month validation cycle before they are fully operational,
then the massive wave of recurring consumable revenue from those specific machine sales will not heavily hit Illumina's income statement until the first quarter of 2027.
Wow, they are planting the seeds right now.
Exactly. The capital expenditure has already been committed by the customer. The machines are physically bolted to the floor, and the future recurring revenue is practically locked in.
It provides an incredible level of visibility into 2027's cash flow.
It really does.
That is the ultimate actionable takeaway right there. The bottom line is that the clinical adoption of next-generation sequencing has crossed the chasm.
Oh, completely.
It is no longer a science experiment confined to university basements. It is the mandated standard of care for oncology, prenatal testing, and rare disease diagnostics.
And because Illumina controls the most powerful hardware and the deepest multi-omics ecosystem, their recurring consumable revenue has become a durable, long-term fortress.
It is a classic story of flawless operational execution. They are ruthlessly managing the variables they can control, like pre-buying memory chips and locking in freight costs, while simultaneously surfing the massive secular tailwind of clinical genomics.
It really is impressive.
So, to quickly recap our deep dive for today, we saw strong top and bottom line beats. We explored a massive wave in clinical consumables that is easily absorbing the macroeconomic weakness in the academic research market.
Yep.
We saw management confidently raise their full-year guidance. And crucially, we decoded the 6 to 9 month validation cycle, which reveals a highly bullish, highly visible setup for a massive recurring revenue spike in 2027.
Which changes the entire complexion of the stock from a speculative biotech play into a mature, highly predictable infrastructure business.
And that brings us to the end of our analysis. But before we wrap up, I want to leave you with one final provocative thought to mull over as you review your portfolio.
Let's hear it.
We have spent this entire deep dive analyzing Illumina through the traditional lens as a hardware company, a company that builds the biological video game consoles and sells the recurring chemical subscriptions.
Right.
But think back to the billion-cell atlas we discussed earlier. Illumina is currently generating massive, unprecedented, highly standardized data sets specifically designed to train artificial intelligence models for drug discovery.
Right, and 6 major biopharma partners are already paying them not for chemicals, but for data.
Exactly. It is a fundamental shift in the value proposition.
It really is.
As Illumina transitions from merely manufacturing the picks and shovels for genome sequencing to actively building the foundational data layer for AI-driven biopharma, here's the question you have to ask yourself.
Okay.
Are the markets currently mispricing Illumina? Are we valuing them as just a highly efficient hardware manufacturer when in reality, they might be quietly transforming into the most important proprietary AI data company in the entire healthcare sector?
It's a fascinating thought.
Imagine trying to read the longest, most complex book in the world, the human genome. But instead of just printing the pages, Illumina is feeding the entire library into a supercomputer to help pharmaceutical companies write the cure for cancer.
If that thesis holds true, the current multiple on the stock might be fundamentally undervaluing their true long-term potential.
It is certainly a thesis worth digging into. Thank you for joining us on this deep dive. Keep your portfolio sharp, keep your insight sharper, and we will see you next time.